Have you ever found yourself frantically jumping in and out of trades, watching your account balance slowly bleed away despite your best efforts? What if I told you that the greatest enemy you face in the markets isn't bear raids, crashes, or uncertainty, but something far more insidious, something within yourself? In the unforgiving arena of financial speculation, one silent killer stands above all others. It's not lack of knowledge, insufficient capital, or even poor strategy. It's impatience. No, the subtle, corrosive vice that separates the losing 90% from the professional 10%. Has this ever happened to you? You spot what seems like a perfect setup, rush into a position before confirmation, only to be stopped out before the real move begins. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the globe. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Stay with me until the end of this video series, because what you're about to discover might fundamentally change how you approach the markets forever. Richard Wyckoff, one of the greatest market operators who ever lived, discovered through painful and expensive lessons that impatience is the beast that must be conquered above all others. His journey from financial ruin to spectacular wealth was built upon this singular realization. The losing 90% believe that speculation is a game of constant action. Their minds, agitated by the ceaseless dance of price fluctuations, develop what Wyckoff called a hankering for activity. They suffer from the delusion that to be out of the market is to miss opportunity, that every tick of the chart represents potential profits slipping through their fingers. These traders exist in a perpetual state of financial motion, jumping in and out of positions, chasing small price movements. Their accounts gradually but inevitably eroded by commission costs and 1,000 insignificant losses. They are, in a word, overtrading. And they fail to understand that this constant activity isn't a sign of engagement, but the very symptom of their impending failure. What I'm going to reveal in this video are the 9 deadly sins of impatience that guarantee most traders will continue to lose money. I'll show you exactly how the professional 10% approach the market with calculated restraint, while the amateurs rush headlong into financial ruin. The path to trading mastery isn't found through some magical indicator or holy grail system. It's discovered through a profound shift in psychology and temperament. Wyckoff learned, with the brutal clarity that only losing millions can provide, that the journey to great fortune isn't through constant trading, but through calculated, strategic, and often prolonged periods of inaction. "There is a time for all things," he wrote, "but I didn't know it." And that is precisely what beats so many men in Wall Street. The market doesn't offer life-changing opportunities every day or even every week. The great primary trends, those powerful sweeping movements where real money is made, are rare and episodic. The time between isn't for trading at all. If you've found value in these trading insights, hit the subscribe button to join our community of disciplined traders. I share these psychological principles because they've transformed my own market approach. It's for waiting, for studying, for preparing, for allowing the market to digest its previous move and build the cause for its next significant campaign. This revelation represents a fundamental mindset shift that transforms amateur traders into professionals. Wyckoff discovered through his own journey that great fortunes come not from frenetic daily activity, but through calculated periods of strategic inaction. The decision to do nothing, to stand aside and preserve capital, often requires more courage and discipline than placing a trade. Behind the scenes of every spectacular market move lies a quiet period of accumulation or distribution that most traders completely miss because they're too busy chasing insignificant price fluctuations. The hidden truth is that these periods of apparent inactivity are precisely when smart money is positioning itself for the next major move. Now, I want to go even deeper into this topic by examining the first of our deadly sins, forcing trades in barren markets. This sin manifests when traders, unable to bear sitting in cash, manufacture opportunities in dull, lifeless markets that are moving sideways in narrow, confusing ranges. The amateur feels an internal pressure, an almost physical discomfort, when not actively engaged in the market. They buy because a stock has dipped a point, or sell because it has rallied too. They're not acting on clear strategic signals, but on the desperate need to simply do something. Their actions aren't driven by objective market conditions, but by subjective emotional needs. Wyckoff articulated this with brutal clarity. No man can always have adequate reasons for buying or selling stocks daily, or sufficient knowledge to make his play an intelligent play. Yet this is exactly what the impatient 90% attempt to do. They try to extract meaning and opportunity from market conditions that offer neither. The professional, by contrast, understands that a sideways market is a fool's playground. It's a zone of uncertainty where the great underlying forces of supply and demand exist in temporary equilibrium. To trade within this range is to be whipsawed, to be ground down by meaningless oscillations that have no predictive value whatsoever. Instead of fighting against these conditions, the professional waits. They possess the supreme patience to sit and observe, allowing the market to complete its digestion process. They recognize that their job isn't to trade the market's indecision, but to wait for the decision to be made, for the battle between buyers and sellers to reach a definitive conclusion that will launch the next meaningful move. This patience creates a profound impact on trading results. While the amateur's account suffers death by 1,000 cuts during consolidation periods, the professional preserves capital and mental energy for the moments that truly matter. Their restraint becomes a competitive advantage in a business where most participants destroy themselves through overactivity. If you've ever found yourself making trades out of boredom rather than conviction, write in the comments, "I'm breaking free from forced trades." This self-awareness is your first step toward trading transformation. The second deadly sin takes this problem of impatience to an entirely different level, as traders not only force trades in difficult conditions, but actually position themselves directly against. The second deadly sin takes this problem of impatience to an entirely different level, as traders not only force trades in difficult conditions, but actually position themselves directly against the market's primary direction. This is what Wyckoff called trading out of season, being a bull in a bear market or a bear in a bull market. The impatient trader, having missed a great advance, grows increasingly frustrated. They look at prices reaching new highs and decide they're too expensive, so they begin selling short, fighting against the market's powerful upward momentum. Or in declining markets, they're forever trying to catch the bottom, buying every minor rally in the belief that it can't possibly go any lower. The revelation here is that in both scenarios, their actions stand in direct opposition to the market's line of least resistance. Through his transformative journey in the markets, Wyckoff learned that this approach is nothing short of financial suicide. His greatest and most profitable campaigns were always conducted in perfect harmony with the primary trend. He was a bull in bull markets and a bear in bear markets. This alignment required the discipline to stand aside, sometimes for months, until the character of the market became unmistakably clear. The 90% lack this patience. They feel compelled to have an opinion at all times, and that opinion so often contradicts the market's own clear verdict. Behind this behavior lies a profound psychological blind spot, the belief that personal analysis and reasoning can overpower the collective decisions of all market participants combined. Now, I want to go even deeper into this topic by examining what might be the costliest manifestation of impatience: jumping before confirmation. This third deadly sin occurs when traders cannot wait for decisive signals before entering positions. They may have performed sound analysis and correctly identified potential opportunities, but they cannot wait for the final, definitive signal that confirms their thesis. The amateur is so afraid of missing the move that they jump in prematurely before the market is truly ready. Wyckoff shared a painful personal story that illustrates this error perfectly. He had developed a strong bullish thesis on cotton. His analysis told him a significant advance was inevitable, but the market remained dull and unresponsive. Consumed by impatience, he couldn't wait. He established a full position. The market did nothing. Eventually, he was forced to sell at a loss. Remarkably, he repeated this mistake 5 times in succession, his impatience gradually eroding a small fortune. Finally, in utter disgust, he abandoned the trade entirely. 2 days later, the real move began. A massive, explosive advance that he missed completely. This million-dollar lesson taught him the supreme value of waiting for the market's perfect timing. The professional trader, therefore, has mastered the art of the patient stalk. They do their analysis, identify opportunities, determine precise entry points, and then do the hardest thing in all of speculation. They wait. This mindset transformation separates those who consistently extract profits from the markets from those who donate their capital to more disciplined operators. If you've caught yourself entering trades too early and getting stopped out just before the real move begins, write "patience pays" in the comments. We've all been there, but acknowledging this pattern is the first step toward breaking it. The psychological battlefield doesn't end once a position is established, however. In fact, it's after entering a trade that the most destructive forms of impatience emerge. But first, let's explore how the professional trader approaches the market with what I call the patient stalk. The master trader has developed an almost predatory mindset when hunting for opportunities. Like a big cat stalking its prey, they identify potential trades through careful analysis, determine their precise entry points, their pivotal points, and then execute speculation's most difficult maneuver. They wait. This waiting period represents a profound inner journey, a battle against one's own instincts and emotions. Join our growing community of patient traders by clicking subscribe below. These market psychology deep dives are designed to help you develop the rare discipline that separates the 10% from the 90%. While the amateur succumbs to tempting preliminary movements, jumping at shadows and false starts, the professional holds their capital in reserve. They watch with detached awareness as the market unfolds its narrative. The revelation here is that they're not waiting for price to reach some arbitrary level. They're waiting for the market itself to announce, through unmistakable price action, that the time for waiting has ended and the time for decisive action has arrived. This patience is not passive. It's an active, mindful state of preparation. Behind the scenes, the professional is constantly refining their thesis, adjusting their strategy, and preparing psychologically for the moment when conditions align. They understand that the financial markets offer a unique form of meditation, the opportunity to observe one's own impulses without acting on them. Now, I want to go even deeper into this topic by examining what happens after a position is established. Once in a trade, the speculator faces their greatest psychological tests. It is here, in the midst of an open position, that the trader's mental mettle is truly tested. The price movements on the screen are no longer theoretical. They represent actual profit or loss, gain or pain. It is here that the impatient 90% commit 2 great opposing, yet equally destructive blunders that guarantee their eventual ruin. These twin sins govern the management of profits and losses. the fatal errors that separate the small, fleeting gains of the amateur from the great, lasting fortunes of the professional. The battlefield shifts from anticipation to management. The amateur, having finally entered a position, often too early, now faces a storm of emotions that cloud judgment. Every tick higher brings a rush of validation and greed. Every tick lower triggers fear and regret. The impact of these emotions transforms rational decision-making into impulse-driven reactions. What's particularly fascinating is how these emotional responses create precisely the wrong instincts at precisely the wrong moments. The exact behaviors that would lead to success become psychologically difficult, while the behaviors that guarantee failure feel oddly comforting and natural. This creates a hidden truth about market participation. The very mechanisms that served our ancestors well in physical danger become liability in financial markets. The transformation from amateur to professional requires rewiring these instinctual responses, developing what Wyckoff called the courage to sit tight. When everything inside you is screaming to act, if you've ever felt the burning urge to exit a winning position too early just to lock in profits, drop emotional mastery in the comments. The next two sins we'll examine reveal exactly how this psychological battlefield plays out through specific trading errors. The fourth deadly sin of impatience, and perhaps the most tragically common, is selling winners prematurely. The amateur speculator, having finally made a correct and profitable trade, experiences not confidence, but a sudden, overwhelming fear. They watch the small green number on their screen, that fragile paper profit, and become terrified that the next price movement will snatch it away. They're impatient for the certainty of a realized gain, no matter how small or insignificant in the grand scheme. The amateur comforts themselves with that old, fatally flawed Wall Street adage, "You never grow poor taking profits." This seemingly wise counsel has destroyed more potential fortunes than perhaps any other market myth. Wyckoff countered this conventional wisdom with the conviction of someone who had witnessed its devastating consequences countless times. No, you don't, but neither do you grow rich taking a 4-point profit in a bull market. This insight reveals one of the great paradoxes in trading psychology. The very fear that drives traders to protect small profits guarantees they will never achieve large ones. The breakthrough moment for many traders comes when they realize their focus on winning the immediate battle consistently causes them to lose the larger war. This fearful impatience is the enemy of all great speculative campaigns. The life-altering wealth, the transformative gains that can change one's financial destiny, are never made in day-to-day fluctuations. They come, as Wyckoff discovered through painful experience, from identifying a powerful primary trend and developing the rare courage to ride it to its conclusion. He stated this as perhaps the most important lesson of his entire storied career. "It never was my thinking that made the big money for me. It always was my sitting, got that? My sitting tight." This revelation stands in direct opposition to the frenetic activity that characterizes most market participants. The impatient trader cannot sit. Their nervous system simply won't allow it. They're like sprinters in a marathon, destined to exhaust themselves long before the finish line appears. The hidden truth is that making small profits is actually easy. It's keeping them and allowing them to compound into significant wealth that requires true discipline. Consider the journey of the typical amateur. They'll correctly identify a bull market, properly select a leading stock, and even time their initial entry with admirable skill. But then they'll sell for a quick 10% gain, satisfying their immediate need for action and certainty, only to watch in agonizing regret as the stock continues its relentless march upward for months, delivering 200% or 300% to the patient holders who understood the real game being played. This dynamic plays out thousands of times daily across global markets, a silent wealth transfer from the impatient to the patient. The marketplace inevitably rewards those rare individuals who can transcend their emotional impulses and align themselves with larger market forces. If you've ever sold a winner far too early and watched it continue higher without you, write "letting winners run" in the comments. Acknowledging this pattern is the first step toward breaking it. There exists a classic story that perfectly illustrates this principle. The tale of Old Turkey, a wise veteran trader whose simple philosophy made him a fortune while others struggled. In Wyckoff's circle, there was an elderly gentleman known as Mr. Partridge, affectionately called Old Turkey by the younger traders. While these ambitious young speculators frantically bought and sold, chasing small profits on every minor rally, the old man would simply hold his positions with remarkable serenity. One day, a well-meaning friend approached him, urging him to sell a stock and lock in a handsome 7-point profit before a potential pullback. Old Turkey simply smiled, shook his head, and responded with profound simplicity. "My dear boy, if I sold that stock now, I'd lose my position. And then where would I be?" This revelation contains a wisdom that most traders never grasp. What Old Turkey understood was that he had achieved perfect alignment with the great primary bull trend. To sell now, to jump out for a small gain, would mean abandoning his advantageous position within that powerful current. He might never be able to re-establish his position at such favorable prices. The true insight was that his focus wasn't on the 7 points of profit he currently had, but on the 70 points that the great trend was still likely to deliver. When pressed by others about his seemingly passive approach, he would respond with those immortal words, "Well, you know, this is a bull market." This simple phrase contained the essence of his fortune-building strategy, and it's a key that the impatient trader never manages to turn. Now, I want to go even deeper into this topic by examining what might be called the dark mirror image of premature profit-taking, the fifth deadly sin of impatience, holding losing positions excessively long. Here we encounter one of the most bewildering paradoxes in trading psychology. The same amateur speculator who was so frantic and impatient to cash in a small profit will now display a level of patience that would make a saint envious. The very trader who couldn't bear to sit with a winning position for more than a day will cling to a losing trade for weeks or even months, watching their capital and spirit slowly bleed away. When a trade moves against them, they are suddenly not impatient for an exit. Instead, they become filled with a desperate, almost infinite patience, born of hope rather than analysis. They tell themselves, it's just a temporary reaction, it will come back. They become impatient to avoid the final, painful act of taking a loss and admitting their mistake. The mindset transformation required here is profound. The amateur must recognize that this seemingly endless patience with losing positions isn't a virtue, but a fatal flaw. Behind the scenes, what's really happening is a form of denial, a refusal to accept the market's verdict on their decision. So they hold on, prisoners of hope, watching small, manageable losses that should have been cut without hesitation grow into monstrous, account-crippling disasters. This psychological blind spot creates what might be the most destructive pattern in all of speculation. If you've ever found yourself unable to cut a losing position because it might come back, write "cutting losses quickly" in the comments. This acknowledgement could save your trading account. This leads us to perhaps the most critical revelation about trading psychology, the fatal inversion of logic that plagues nearly all unsuccessful market participants. Here's the great paradox at the heart of losing trades. The 90% are impatient with their profits and infinitely patient with their losses. The professional, as Wyckoff learned through painful experience, must do precisely the opposite. The master trader develops the rare ability to be supremely patient with winning trades, giving them all the time and space they need to develop to their full potential. Simultaneously, they cultivate a ruthless, almost merciless impatience with losing trades, eliminating them the moment they prove themselves to be mistakes. This mindset reversal represents one of the most profound transformations a trader can undergo. Wyckoff articulated this principle as the great central law of the psychological game. Instead of hoping, he must fear. Instead of fearing, he must hope. He must fear that his loss may develop into a much bigger loss and hope that his profit may become a big profit. The brilliance of this insight cannot be overstated. The sin of holding losers is essentially the sin of allowing hope to exist in a situation where only fear is appropriate. The impatient trader facing a loss becomes fixated on getting even. They develop an overwhelming urgency for the market to reverse and restore their lost capital. This desire becomes so powerful that it blinds them to the objective reality of price action, which is clearly telling them that the trend is against them. The hidden truth is that they're no longer trading the market. They're trading their own emotional needs. Now, I want to go even deeper into this topic by examining the sixth deadly sin of impatience, the desperate need to recover losses. After a speculator suffers a painful loss or series of them, their decision-making undergoes a fundamental shift. Their mind is no longer focused on calm, rational analysis. It becomes consumed by a single burning desire to win back what was taken from them. They are no longer speculators. They are individuals seeking revenge. And the market, as countless traders have discovered, is perhaps the most terrible and expensive place on earth to pursue a vendetta. This need to get even represents a particularly destructive form of impatience. The trader feels they must recover their losses immediately on the very next trade. This desperate urgency obliterates all sense of proportion and adherence to sound principles. Rules that were established during calmer times are quickly abandoned. Position-sizing disciplines that protected capital are replaced by reckless bets far larger than their accounts can safely sustain. All this happens in the hope that a single lucky victory will erase the pain of previous defeats. Wyckoff knew this dangerous mindset intimately. He warned against the great folly of trying to make the market pay for a specific need, whether it was a lost sum of money, a new car, or any other financial obligation. His observation was both simple and profound. What does a man do when he sets out to make the stock market pay for a sudden need? Why, he merely hopes. He gambles. If you've ever found yourself increasing position size after a loss to make it back faster, type "trading with clarity" in the comments. This acknowledgement could mark the beginning of a tremendous shift in your approach. The professional's antidote to this destructive impulse involves a remarkable exercise in self-control that few traders ever master. After a significant loss, they understand that the most important action is often no action at all. They step away from the market, allowing the emotional storm to pass and regaining their psychological equilibrium. The revelation here is that lost capital cannot be recovered with one desperate, impatient lunge. It can only be restored methodically by returning to proven, disciplined methods and waiting patiently for genuine high-probability opportunities. The 90% frantically try to get even. The 10% focus simply on getting it right the next time. This distinction reveals a profound difference in mindset that extends beyond individual trades to a trader's entire relationship with the market. Now, I want to go even deeper into this topic by examining what might be called the ultimate test of a speculator's mastery over themselves, the seventh deadly sin of impatience, the inability to sit in cash. This challenge represents the final frontier in trading psychology, the summit of self-discipline that few ever reach. The amateur is essentially addicted to action. They believe that to be out of the market is to be idle, unproductive, missing opportunities. They experience a constant nagging, hankering for activity, as Wyckoff described it. Their capital, if not deployed in some position, feels like a wasted resource. The journey to mastery involves recognizing a counterintuitive truth that cash itself is a strategic position and often the wisest and most profitable position of all. Wyckoff understood with perfect clarity that genuine fortune-making opportunities are remarkably rare. They don't appear every day or even every week. They emerge as the culmination of weeks or sometimes months of quiet preparation within the market's underlying structure. The professional speculator's mission is to develop the supreme patience required to sit and wait for these gilt-edged opportunities to present themselves. To be constantly jumping from one minor fluctuation to the next virtually guarantees that when a truly significant move finally begins, you'll either find yourself positioned against it or have your capital so depleted that you cannot establish a meaningful position. The awakening comes when a trader finally internalizes what Wyckoff articulated with the force of natural law. There are times when one should speculate, and just as surely there are times when one should not speculate. To know the difference is to know the very heart of the game. The 90% driven by impatience trade constantly. The 10% have the discipline to trade only when the great impersonal probabilities are overwhelmingly in their favor. The rest of the time, they sit, they observe, they study, they wait. This ability to remain in cash represents the source of the professional's greatest power, a clarity of mind that the amateur can never achieve. A trader holding a position is always, on some level, seeking confirmation of their existing opinion. Their perception becomes colored by their own bias. But the individual sitting in cash maintains no bias. They view the market with perfect detachment and objectivity. They're not hoping for it to move up or down. They're simply observing its behavior, waiting for it to reveal its true underlying character. If you've ever felt the pressure to always be in a trade, because that's what traders do, write strategic cash position in the comments. This realization could be the beginning of a genuine breakthrough. Wyckoff captured this principle perfectly when he said, "Remember this, when you are doing nothing, those speculators who feel they must trade day in and day out are laying the foundation for your next venture. You will reap benefits from their mistakes." The impatient 90%, with their constant unprofitable churning, create the very market conditions. The tops, the bottoms, the breakouts that the patient professional is waiting to exploit. Perhaps the most illuminating example comes from the story of a remarkably successful speculator who lived in the California mountains and received his market quotations 3 days late. Despite this seeming disadvantage, or perhaps because of it, he achieved extraordinary returns. His perspective was profound. "I make speculation a business. I would be a failure if I were in the confusion of things and let myself be distracted by minor changes. I like to be away where I can think. Real movements do not end the day they start. It takes time to complete a genuine movement. By being up in the mountains, I'm in a position to give these movements all the time they need." This journey through the deadly sins of impatience reveals something profound about not just trading, but life itself. The ability to wait, to stand aside while others frantically chase immediate gratification, is perhaps the rarest and most valuable skill in any competitive arena. It requires a level of self-mastery that few achieve, but all can aspire to. If you found value in these insights today, I'd love to continue this conversation with you. Subscribe to the channel if you're interested in more deep dives into the psychology of financial markets and the timeless wisdom of market masters. These principles have transformed my own relationship with the markets, and I share them with the hope they'll do the same. For you, Drop a comment saying patient prosperity if you made it to the end. Your engagement helps this content reach others who might benefit from these hard-won lessons. A simple like on the video creates that ripple effect that helps spread these ideas further. There's a video right here that explores the concept of market structure and accumulation patterns, the perfect complement to understanding these psychological principles. Click and continue with me over there as we decode the fingerprints of professional operators in the markets. Until next time, remember that in speculation, as in life, patience isn't just a virtue, it's the path to prosperity.